Hello and a very warm welcome to Policy Watch, our weekly show that keeps you abreast of all the major economic developments during the week. Today we'll kickstart our show with the Pension Fund Regulatory and Development Authority Bill that was finally passed by the Lok Sabha after years of dilly-dallying. We then move on to the new RBI Governor, Dr. Raghuram Rajan's statement, and finally close with a somewhat conflicting macroeconomic news that we have, with the core sector showing some recovery, even as the PMI for manufacturers shows a fall. And to discuss these stories with us is Devendra Pant, Chief Economist at India Ratings. Welcome to our show, Devendra. Well, after years of dallying, the Lok Sabha finally passed the Pension Fund Regulatory and Development Authority PFRDA bill. The bill gives statutory authority to interim regulator and brings greater clarity in the area of social security. The bill, as passed by the lower house, incorporates two key amendments based on the recommendations of the Parliamentary Standing Committee on Finance. One is to give subscribers an option to invest in a scheme that gives them some minimum assured return as fixed by the regulator. The other is to bring the FDI cap of 26% into the legislation itself, instead of leaving it to be determined by the rules. Will this be the cursor for one, enabling greater labour flexibility, and two, ensuring greater flow of funds into the infrastructure sector? Let's find out what Devendra has to say. But first, this Bureau report.
माननीय अध्यक्ष जी, bill as amended is passed.
Lok Sabha convening amid slogan shouting on Wednesday, the day designated for the pension reforms bill in the House. Amidst the din, Finance Minister P. Chidambaram introduced the Pension Fund Regulatory and Development Authority Bill 2011, even as the House had to be adjourned.
To meet again at 2 p.m.
After another adjournment, the discussion resumed with the main opposition party expressing support for the bill.
सपोर्ट इसलिए कर रही है कि देश आज क्राइसिस में, और क्राइसिस में कैसे है, 91 से भी ज्यादा बड़ा क्राइसिस, जिसमें पेंशन रिफॉर्म्स की सबसे बड़ी आवश्यकता है.
The reservations against several provisions in the bill were expressed by the left front and the regional parties led by BSP, RJD and TDP.
There are more than 1 crore central state government employees, bank employees and other employees. Why these two categories of employees is now being created? It is violative of the Constitution. It violates Article 14, right to equality. This bill violates the Article 14 of the Constitution, right to equality. Yes. They are creating two classes of employment.
In his reply, Finance Minister P. Chidambaram assured the House that the national pension scheme would be improved and made more secure.
All the recommendations have been accepted of the Standing Committee. Only this one recommendation we have not been able to accept, and I've given you the reasons.
The Rajya Sabha passed the bill on Friday. Experts say that with the passage of the bill, the national pension scheme could see an exponential increase in the subscriber base of nearly 53 lakh members at present. Vishal Daya, Rajya Sabha TV, Delhi.
Well, Devendra, the biggest, the plus from this legislation really is that it will bring a lot of funds into the infrastructure sector, given that's been estimated that we have such a huge deficit, $1 trillion in the next 5 years is what the estimates say in the infrastructure sector. Pension funds have long-term funds. So will this really help bridge the infrastructure deficit? What do you think?
Well, this is a bill which has solved the problem partially. Because when we look at the infrastructure sector, be it the physical infrastructure or when we talk about the urban infrastructure, most of these projects have the long-term duration and they need a funding for a longer duration. Now what was happening is, even if some of these people hit bond market and do the borrowing, most of the bonds, be it the private placement or public issues, they have the 10-year tenor. Whereas these infrastructure companies, or so to say, the projects, the money which is required for urban infrastructure, they need money for a longer period so that there is no asset liability mismatch. So they need money for the 15 to 20 year time period. And here are these pension funds and provident funds, those who are looking for that kind of investment where they get the money for they can invest for a longer duration. A pension fund and provident fund generally looks at 15-year or 20-year time horizon. So if we look at it from that angle, there is some problem which is cured. It is not fully cured, but partially it is cured.
So as far as the infrastructure sector is concerned, pension funds, the entry of pension funds is a big plus. But if you look at it from the investor's point of view, do you think people are willing to accept, because under the new NPS or National Pension Fund as they call it now, the entire risk is shifted to the subscriber. So as against defined benefit which you had under the government pension schemes, you now have defined contribution. That means I know what I have to contribute, but at the end of the day when I finally retire, I don't know how much I'll get. So will the Indian public really accept a scheme like this?
Well, look at it, how this thing has started, the new pension scheme, and it was introduced in, way back in 2004 or so. The way the life expectancy has increased in India, some estimates puts it a number like going forward maybe after a gap of 10 years or 15 years, the pension liability will be more than the salaries liability.
Yeah.
And looking at the kind of fiscal situation we have, there will be a big problem on the government, not only the central government, but on the state government's budget. And if you look across the world, it is not possible for any government to provide that kind of support.
So it makes eminent sense from the government's point of view, from the side of the infrastructure sector point of view. But do you think to make ordinary investors subscribe to something like this, do you think some SOPs need to be given? There are no tax SOPs associated with this. So should the government look at giving some kind of incentives for people to buy into a scheme like this?
Well, the contribution which goes for this pension scheme, that attracts a tax rebate. Now, what kind of tax regime, as Mr. Chidambaram used to say, EEE, whether EET or TTT, nobody knows. But as of now, whatever comes from the pension, that is non-taxable. Now, when we are talking about, look at it from this way, an individual who is entering in a job market at the age of say 25 years, and he or she is retiring at the age of 60 years, so 35 years is a long horizon. Now, I don't know what kind of flexibility is given, whether the flexibility in the sense like when the individual is in the beginning of this of his career, whether they can opt for equity scheme and later on.
No, you are allowed to shift.
Yeah.
So given that, you think it's a good thing for the investor also?
Yeah, see, the one who is in the younger age would like to have some kind of risk taker. So may go for 10 years in the form of the equity, and over a period of time, there is an option.
It's win-win really for all three. So at that note, I think Devendra, we'll have to interrupt you over there because we have to go into a very short break. But we'll be back very soon. Please stay with us. Welcome back. Well, a change of guard at the RBI normally tends to be a very low-key affair, in keeping with the style of central bank governors. But in a break from the past, Raghuram's entry into the RBI as the 23rd governor was anything but low-key, unveiling a wide-ranging and ambitious program that covered almost all the issues that the bank is presently grappling with. Raghuram started by raising the bar for himself. Will he succeed in delivering on what he himself has called only a part of his short-term program, even if many of the measures he announced were decidedly more medium to long-term in nature? Let's see what Devendra has to say, but after hearing this Bureau report.
The new chief of the RBI hit the ground running on Wednesday, announcing a slew of measures to shore up investor confidence and support the falling rupee.
Deputy Governor Urjit Patel, together with a panel he will constitute of outside experts and RBI staff, to come up with suggestions in 3 months on what needs to be done to revise and strengthen our monetary policy framework. I talked about the primary role of the RBI as preserving the purchasing power of the rupee, but that is not its only role. We have 2 other important mandates: inclusive growth and development, as well as financial stability.
The markets greeted the new governor's announcements with a rousing cheer. Both the rupee and the Sensex showed immediate improvement, although Rajan himself cautioned against expecting any quick fixes.
This is not an easy time. The economy does face challenges. At the same time, India is fundamentally a sound economy with a bright future. Our task today is to build a bridge to the future over the stormy waves produced by global financial markets. I have every confidence we will succeed in doing that.
Much of the task ahead for Rajan was put in perspective by the Prime Minister. Before leaving for the G20 summit, he said, and I quote, "I will emphasize in St. Petersburg the need for an orderly exit from the unconventional monetary policies being pursued by the developed world for the last few years so as to avoid damaging the growth prospects for the developing world."
The economy is challenged on many fronts. The Reserve Bank has a responsibility in navigating the economy out of the current pressures. The country could not have asked for a more capable person than Dr. Raghuram Rajan to lead the Reserve Bank at such difficult times.
This year, before Rajan took over, the rupee had lost 1/5 of its value against the US dollar following major capital outflows. India is also suffering a decade-low growth. The GDP rose just 4.4% in the first quarter this fiscal, its weakest performance since 2009. Rajan's biggest challenge would be to neutralize the impact of narrowing down of the US bond purchases. He is expected to come out with his first policy statement on September 20th. Bureau Report, Rajya Sabha TV.
Well, Devendra, were you surprised to see Dr. Raghuram Rajan making such a sweeping statement the day he took over?
Well, one can argue both ways, yes and no. Yes, in a way, because the sentiments were really down and out.
Okay.
What we believe, the way rupee is behaving, though fundamentally there is a weakness, but the way it has behaved, especially in last 1 month or so, it is more under kind of speculative attack.
So much of volatility, particularly.
So much of volatility, and at that time, somebody has to come out and calm the nerves.
Okay.
The PM has done its part. The FM has done its part. The outgoing governor has done its part. So the only party left was the incoming governor. Ideally, the central bank governor should be away from all these things like, and thank God he hasn't commented on the level of rupee, like where rupee should be, whether rupee should be at value X or value Y. But yes, what has it done? It has done, in a way, wonder to the market.
Except that can it be sustained? Because after all, one man cannot change anything overnight. So what explains the market's reaction?
It's more or less A, the welcome, B, there will be the short-term volatility, which was, rupee was swinging way up or way down, whichever one wants to look at it. That short-term volatility has come down. Where it will settle, nobody knows. But at least still the structural weakness of the economy are not resolved. One single man or two person cannot achieve that target.
Especially if you see that whatever he has announced, on the forex front, whether it's in terms of swaps and rebooking of cancelled contracts, etc., all this can only address one part of the financing of the deficit. But the size of the current account deficit, the ball over there lies squarely in the government's court. So what can the RBI governor do? Yet markets seem to feel that he's got some kind of magic wand, though he himself said, I don't have one. So what really explains, and do you think there is some merit in what he says? Will he be able to really bring some kind of stability, at least in the short term?
Well, I look at it this way. What he was able to do, calm the nerves of the market participants. So the way when the 2 days back you talk to any policymaker, or not the policymaker, any analyst, everybody was looking way down. But at least in last 2 days, people have started saying no. Some of the measures he has announced, people are talking about there will be inflow of $10 to $30 billion by that. Now what we are looking at, we are again we are looking at all these are debt creating inflows. Mind you, the rupee will behave the level of current account, but more than that, even if we have the money to finance that current account, if it is coming from the debt creating capital inflows and portfolio investment, rupee will always remain weak. So somehow we have to turn the tide. We have to make it the money or the capital inflows coming into India are more non-debt creating, which is the foreign direct investment, which will not leave our shores.
Except that foreign direct investment, the government has tried to raise the ceilings in so many sectors. But do you see any foreign direct investor coming in at the time when we have these elections looming in front of us? Because there's always a fear that the next government may reverse these measures. So do you see any FDI flows really happening till after the elections, once we've got a stable government and investors know what to expect?
Well, even if we go by the past 12 years record of economic reform regime or period, there were not many decisions which was reversed.
That is
so
true.
that is one thing. And it is now the responsibility of our political classes to send out this message outside India so that the collectively will fight and will work in the favor of Indian economy.
Okay.
There will be some capital inflow, something, but it is not that you decide. Even if it is, even if say the elections are 5 years down the line, if you announce some measure today, it will not give you the direct for FDI or for that matter the domestic investment. It will take some time. It will take couple of months. It may take more than 2 or 3 months. But the one thing which we are I'm looking at and we are that is the first three months of this fiscal. The FDI inflows has been relatively better compared to last year. There are certain other things which are happening in the Europe, US and all those. Because of that, there is some demand in the global economy which is being generated, and there's some downward pressure on the current economy.
Except that the RBI governor has two imponderables. One is of course the government, and then we also have the Fed tapering. But on this note, again, I think we'll have to slip into a very short break, but we'll be back very soon with our third and last story. Welcome back. Well, first the good news. Core sector output touched a 4-month high in July. Since the core sector includes sectors like electricity, mining, steel, etc., that contribute about 38% to the index of industrial production, the hope is that the worst is behind us. But along with that comes the good news, comes some bad news as well. The HSBC Purchasing Managers Index, which is a survey of the level of 500 manufacturing firms, fell for the first time in more than 4 months too in August 2013. To add insult to injury, China's PMI grew for the first time in 4 months. Europe too seemed to be in better shape. So will the good news outweigh the bad in the coming months, or is that merely a flash in the pan? We'll ask Devendra for his take, but first this Bureau Report.
Eight key infrastructure industries grew 3.1% in July 2013, translating into 1.17% overall industrial growth, raising hopes of a reversal of the lackluster industrial performance in recent months. The growth marked a 4-month high for the sector that carries a weight of 38% in the Industrial Production Index. The revival mainly on account of strong growth in steel, petroleum refinery products and electricity industries. Steel production grew fastest at 7% as against just 1.1% in July last year. Electricity generation increased 5.2% again compared to 2.7% last year. Natural gas production falling since December 2010 continued the trend. Gas production fell 16.1% in July against a fall of 13.5% last July. Crude oil production also fell 2.3% against a 0.7% decline last July. The figures are expected to help the July factory output data that will be released later this month. But economists say it's difficult to predict a trend based on just 1 month's data. The industrial sector has been sluggish for over a year. Production contracted 2.2% in June, mainly on account of a 2.2% decline in the manufacturing sector. All of which has contributed to global forecasters pegging India's GDP growth for the current fiscal at less than 5%. Bureau Report, Rajya Sabha TV.
Well, Devendra, how do you look at it? Is the glass half full, half empty? Core sector looks up, but the PMI, and we've recently again got the PMI for services, both of which show that it's very much on the downside. So where are we macroeconomically?
Well, there are definitional issues. If you look at what PMI measures and what IIP measures, See, in IIP we are talking about only industry.
Industry, yes.
That too, mainly it's the registered manufacturing and the registered sector. PMI is a forward-looking. It is based on your orders and other things.
Yeah.
It's a 500 company sample, and mind you, in India, most of the industrial production is with SSI and SMEs.
Absolutely.
And which PMI does not capture. And even if you look at the past history, there has been instances when PMI says the contraction and you get an expansion.
Okay.
But having said that, I will not negate PMI trend at all. What we can look at it is more as the signal, initial signal of all is not well with the industry. If you look at the latest RBI data which has come released yesterday, the non-food sector credit growth has gone up to 17%. This is after November 2012. But there is a catch in that. Catch is that since CP and CD rates are so high,
that's true.
The corporates are going to the bank loan for financing of their working capital. So we have to look very carefully in these numbers. So I'm concerned about falling PMI number of the new orders. But looking at, as I said in the earlier capsule, like your core sector has gone up. We have looked at the July exports number. We are looking at the Europe is out of recession, though the growth is just 0.3%. US economy is doing well, and then that's why they are talking about tapering of the QE. The Japanese economy is doing
so
well.
all around the world there is some recovery.
There is some recovery.
And to the extent that core sector really looks at investment, in infrastructure investment, that is productive investment, which should be the trigger for GDP growth, there is a faint glimmer of hope. But on that note, Devendra, we come to the end of this program. It's been great having you. But before we close, a quick look at the key takeaways. Well, as far as the first story is concerned, I think the news really is good, fairly good all around, because it's win-win for both the subscriber, for the pension fund sector, as FDI, as well as for the infrastructure sector, which gets funds. As far as the second story goes, the new governor in the Reserve Bank of India, there are some pluses, some minuses, but to the extent that he seems to have restored some sanity in the forex market, it certainly is welcome. We'll have to see whether that gets sustained, but for now, it's certainly good news. As far as the mixed signals with the core sector looking up, the PMI looking down, well, to the extent that all over the world, recovery seems to be in the air, maybe India also is not too far behind. With that, we come to the end of this show. It's been great having you, but please be sure we'll be back next week, same time. So till then, it's goodbye from all of us at RSTV.